The Australian dollar is closing in on the week with modest gains, a surprising turn for a currency that has spent the last several weeks on the back foot. The Aussie dollar fell about 2 cents in November, hitting 6-week lows late last week at around 67.50. But earlier this week, the Aussie dollar jumped, recouping about half those losses in just a couple days. The Aussie's recovery momentum has stalled as we go into week's end, but at around 68.30, it is now comfortably sitting back inside that very familiar 67 to 69 range, where the Aussie dollar has been travelling for over 4 months now. The Aussie's gains this week are mostly attributable to a 2-day bout of US dollar weakness, which has left the US dollar lower against all G10 currencies. But the Aussie's bounce this week is still unusual, given the important local data releases showed that the Australian economy is still struggling. Aside from that, there was also a modest bounce in the Aussie on the RBA's rather upbeat statement and reference to long and variable lags in the transmission of monetary policy, which implied no urgency to ease again. But within 48 hours, the RBA's optimistic growth view took a major hit with dismal details of the Q3 GDP release. The RBA's meeting schedule, the first Tuesday of the month, regularly puts them in the awkward position of having to make assessments of the economy and policy before the most comprehensive report on the economy, quarterly GDP, is finalised. The statistician releasing that data on the first Wednesday at the end of each quarter. And so that awkward clash proved itself once again this week, as the RBA repeated its view that the Australian economy appears to have reached a gentle turning point, only to see those expectations dashed by another disappointing GDP update. Australia's Q3 GDP grew by 0.4% in the quarter, short of expectations. On the positive side, there were upward revisions and annual growth has improved from a post-GFC low of 1.6% in Q2 to 1.7%. But that is not much to cling on to, and the report was overall very disappointing, especially considering the breakdown, which shows almost all growth coming from government spending while the private sector is still struggling. Government spending is up a swift 5.2% over the last year, such that 1.2 percentage points of the 1.7% growth rate is due to public spending. Private sector demand, on the other hand, is down 0.4%, the weakest reading since the GFC, with weakness broad-based across home building, business investment and consumer spending. That represents the 5th consecutive quarter where private final demand was either flat or contracted. Retail sales for the month of October underwhelmed too, unchanged in the month and below expectations for a 0.3% gain. Trade tensions remain a focal point as well, developments a little less reassuring this week. Talks for a narrow Phase 1 deal appeared to be in their final stages, with US officials suggesting they were down to short strokes and that millimetres separated US and Chinese negotiators. But President Trump dented those hopes and threw markets for a loop by casually suggesting that his administration's eagerly awaited trade deal might not happen until sometime after 2020. The president saying that he has no deadline and he likes the idea of waiting until after the election. Those comments are discouraging for hopes his administration is on the verge of de-escalating its trade war, since they signal that the Trump administration is comfortable settling in for a long-haul conflict. Until that moment, Washington and Beijing were seemingly getting close to a preliminary deal that could roll back some tariffs and avert a new round set for December. The US administration also said that they were going to slap tariffs on steel and aluminium from Brazil and Argentina. That was a very surprising and completely unexpected move that opens a new front in the trade wars and widens Trump's global trade war into 2 of the largest economies in South America. In a tweet, Trump blamed both nations for devaluing their currencies and hurting American farmers in the process. But it doesn't end there. The US also proposed levies on France as punishment over a tax that hits large American tech companies. So the news on trade tensions hasn't been helpful for market stability this week. But encouragingly, US officials said that Trump's lack of urgency for a US-China deal shouldn't be understood to mean that current talks were stalling. Weak Australian data and these trade jitters sapped the Aussie dollar's recovery momentum, but it is still closing the week with some modest gains against the US dollar. The local calendar next week includes a speech from RBA Governor Lowe and confidence updates from the NAB's business survey and Westpac's consumer sentiment survey. Next week is crammed with weighty global events too, including the UK general election, a US Fed meeting, the ECB and the December 15 China tariff deadline. The dollar likely takes its cue from these offshore events near term. The UK general election is on Thursday, December 12, and recall Boris Johnson called this election in the hopes of gaining a majority which could break the Brexit impasse of the past 3 years. Polls show a Conservative Party that is likely to win a solid working majority, but his lead has narrowed as Labor support has lifted. Global markets are taking their cue from the polls and are expecting the Conservatives to gain a solid majority. Any major surprises will produce some large swings for cable and risk appetite next week. The Fed is expected to keep rates on hold after cutting rates 75 basis points earlier this year to guard against risks to the global economy. Markets will be eagerly awaiting the Fed for insights about the direction of policy next year. Markets currently expect the Fed to cut rates once this year, but the Fed has been signalling that it expects to keep rates on hold. Trade talks should come to a head next week as well. 15th of December is the date when a 15% tariff on another $160 billion in Chinese goods goes into effect, many viewing these tariffs as potentially the most damaging since they directly target consumer goods. Many are using the 15 December deadline as a barometer. If a Phase 1 deal is on the cards, those tariffs will be delayed and possibly postponed indefinitely. But if a deal is on the rocks, those tariffs will go ahead. Brace yourself for a big week ahead.